G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from AllenWargent Property Buyers, and I'm here with Chris Bates from the Alcove Mortgage Specialist. Chris, how's your week been?
Doing well, Pete. I am quite boring, to be honest. Nothing exciting to report on here. We're in the midst of winter, and nothing exciting really. What's happening in your world?
Yeah, similarly quiet up in London this week. It seems like half of Australia is in London at the moment, or maybe that's just the places I'm hanging out. But it's been it's been a blistering hot week actually. Probably too hot. Anyone who's been to London would know it doesn't cope too well when the temperature gauge gets up towards 30 because there's no aircon and the tube, and you know what it's like. You know exactly what I mean. So it's been pretty good, and everyone's been catching up with the origin and everything. And every time I read a news article from Australia, it sounds like there's a bit of FOMO kicking into the housing market. And we're just chatting to my business partner Andrew, and the rate of inquiry has picked up a notch over the past few weeks, to the extent we're starting to worry about capacity constraints as the year goes on, because he's got a bit of a holiday coming up himself, and we're getting a bit stretched to the seams. But how about you guys? Have you seen any sort of pickup in mortgage inquiries since the rate cutting cycle began?
Look, it's interesting. We're always just tracking it, right, and just trying to listen to how our clients. And we've got sort of a number of different sort of client pools. We've got people who've spoken 2 years ago. We've got people that we've spoken in the last year or two that are thinking about doing something. We've got, obviously people actively looking now, and then we've got existing clients as well. And we're just sort of trying to always gauge, how things are shifting. The shift we've probably seen in the last couple of weeks is our existing clients are coming back, often to look to buy investment properties, and they're getting more confidence to do so as rates are coming down. So that wasn't really the case, I reckon, for the last 12, 18 months. That was, there was obviously investors out there, but I wouldn't say that we had a lot of our existing clients coming back as investors, but absolutely in the last few weeks, I've noticed a big shift there. So obviously people are getting more and more confident around where rates are going, and it's a good time to invest if they've got the capacity. Upgraders are there. We've had a couple of really big purchases over the last few weeks as well, which and some of them actually gambled to sell first, and then knowing that they really want to secure something, and both of them have actually paid off, which is good. Got one guy literally in negotiation right now, because it's always hard when you're upgrading. Do you sell first or do you buy first? Sometimes it's really hard to do either. So that's first time buyers. I'd say it's just the normal trickle. I think there hasn't been too much media around the 5% deposit scheme. But I reckon that's going to start to really pick up over the next few months, where it gets closer to January when that policy kicks in. And I think more people are going to be aware of how much of an impact that's going to have on the market. It's definitely some FOMO stories happening. There's one in the SMH, which I shared with you, Pete. Elizabeth Knight put it out there. And it is kind of I guess, a good reading on how we're seeing it as well. I wouldn't say it's complete FOMO, but I do see that there's, I guess, an optimism around where rates are going.
Yeah, you actually called me on the hop last week when you said about the house price expectations in the Westpac survey, because I'm usually pretty good on stats, but it was good to see Elizabeth actually mentioned this in her article. Measures of house price expectations surged in May to the highest level since 2010, according to UBS, a view echoed by the Westpac survey, which said the highest level since 2013. So quite a big change or turnaround in house price expectations, which is exactly what you said last week, by the way. So I wasn't quite sure if it was the rate of change or whether it was the highest level. It's the highest level in at least a decade. So that's a massive turnaround since interest rates started falling. And just chatting to Andrew up in Brisbane this week, he said there's just that sense of FOMO. You usually get it from clients saying things like, how quickly can you start an engagement? Or, we're really pushing the mortgage brokers to get the approval through, things that we just weren't hearing 6 or 12 months ago. So I think, in Elizabeth Knight's article, she talks about sort of a big pickup in lending or owner-occupier loans for National Australia Bank, bit of a jump, a 3-month period, a 16% increase for first home buyer loans compared to the same period last year. And she said there's two things at play. First is pent up demand because of people waiting on the sidelines previously. And that does tend to happen. We saw it during the
Yeah,
Banking
absolutely.
World Commission. And everybody kind of just sits around thinking, well, if prices are moving in my favor, what's the hurry? And the second thing is just, I guess, the expectation of interest rates coming down, which I guess market pricing does point towards as well. Victoria is leading the way with NAB's loan growth, with first home buyer activity up 28%, followed by WA 22% and Queensland 21%. So, yeah, I guess I don't know whether FOMO is the right word, but just getting that sense that there's a bit more urgency, I think. It's still early days in the cycle, I would say. But yeah, I guess a few sort of headlines like that do tend to sort of start moving people in that direction.
Look, we are herd animals. We'd love to say that we like to be outside of the herd and do something differently to everyone else, but unfortunately, we just human nature is we don't. And obviously, when the confidence comes back, and then everyone's all of a sudden, oh, we've got to get in now, and that's what everyone else is thinking as well. And unfortunately, in a place like Melbourne, though, it made sense to sit on the sidelines the last few years. It's been very lackluster growth, but wouldn't want to be buying in Melbourne right now. I think you've sort of missed that opportunity. There's kind of like when Perth really did a big run over the last few years. I feel like Melbourne's going to have its bit of a day there the next 6 months. And, you don't really, because the chance of getting great assets really declines when the market gets hot. Unless you're willing to pay really above anyone else, you've got to be the highest bidder. And so you've got to be really confident, and you've got to really go, you're the one setting the new price level. And you've got to have a real confidence to do that. And so I think what happens is a lot of buyers don't have that confidence. Then they miss out, and then the weeks tick by, and then prices keep running, and they could have bought a better property for a better price, just say 3 months ago. And that's really hard. You end up chasing your tail, and you get emotional, etc. So yeah, often buyers, they don't really want to, step out and buy when everyone else is a little bit fearful. And that's usually the chance you've only got to get great assets is usually in those markets, I feel, to get them at fair prices. And I think we can see it from different ways, how buyers are acting. So obviously inquiry is the first thing. It's also, once we have those first call, we request some documents from clients, and, our sort of doc return rate, when the market's got a bit more positivity behind it, the clients, because they've got to do a bit of work, if they're motivated, they get the docs back really fast. And so our return rate goes up, and also the time it takes to get documents returns really reduces. And we've seen that over the last 3 or 4 weeks. The second thing is when clients that we've sent them strategies, do they sort of agree and then sign their loan application forms really fast? And so we've seen that pick up over the last, probably the last month as well. So that's obviously a sign that demand's increasing. But listings, there's always a lag, Pete. And I think that's when demand increases, it's really matters on how many listings are on the market. Is there an oversupply? Is there, a lot of choice for buyers? When you look at sort of 10-year levels, averages on 10 years and even on 5 years, we're way down. And so you have to say it's an undersupplied market of good properties. And even if sellers wanted to list, there's always a lag. It takes 1 to say 3 or 4 months to get your property on the market. Usually you've got to tidy it up. You've got to get an agent. You've got to style it. You've got to paint it. And you've got to kick a tenant out. There's usually a process you've got to go through to list your property. Or you've got to buy another property. And so sellers are always a bit slower to enter the market, and buyers can enter, almost instantaneously.
I think that's maybe a third factor in the FOMO is the shortage of housing. I think when we talk about housing supply, there's different ways you can think about that. One is the listings, the properties listed for sale, as you're just talking about. And if you look at a country like Canada, when the sentiment changes in the market and people sense that they might be at a peak in the cycle, then more people look to sell, and then suddenly you get this build up of inventory and prices start to fall. Now, we're not at that stage of the cycle in Australia, but I think the other thing is just the physical shortage of housing. And there was a report out this week by Charter Keck Kramer underscoring that we need 90,000 new residential building workers, according to Build Skills Australia, to build the 1.2 million homes that the government as promised over 5 years. But also, they were just saying that realistically, it's going to take more than 5 years to address the shortage of housing. 240,000 new dwellings a year. Well, that's never been done before. I think in 2017, Australia saw the delivery of about 220,000 dwellings, but that was a totally different time in the housing market cycle, as they point out in the report. There was people were buying. There was a massive release of greenfield sites. There was high-rise apartments going up all over the country. Costs were much lower. We've currently got interest rates are a handbrake. We've got the lending assessment buffer. There's just so many things that are making it very unlikely that 5 years from now we'll be talking about 1.2 million homes being delivered. So they've suggested we need planning reform, tax reform, immigration reform. But even if you were to implement some of these things like planning reform, well, that could take up to 7 to 10 years to flow through. So yes, there's housing supply, as in the listings for sale, but also, as Charter Kramer points out, we're just not going to build enough homes for all the people that we need to over the next 5 years. Even if we were building flat out, we wouldn't get to 1.2 million, and we're nowhere near that stage yet either, I suppose.
Yeah, I think interesting. The New South Wales government just extended some tax rebates that they have for the build to rent sector, and I think there definitely needs to be more and more reform. I think from every element. Yeah, builders need to be able to build it cost efficiently. Prices probably have to go up. Maybe borrowing capacity has to go up. Maybe taxes need to go down for developers. So, they're just, the numbers aren't stacking up. Hence why we're just continuing. Yeah, you can set these big targets, but do you actually build them? That's a different story. And unfortunately, the feasibilities don't make sense. And developers aren't charities. They're not social enterprises. They have to build for a profit. If they can't build it today, they'll delay. And I didn't realize that's a pretty good rhyme, that one, Pete. But should we go on with story number 1, mate?
Yeah, so this is our weekly 2 cent segment where we go through the big 3 property news stories of the week. And stick around because at the end we'll go through a few of your listener questions in our Q&A before we wrap up. So yeah, first news story this week from Cameron Cusher, who's I think now working as an independent consultant, previously with the REA Group. And his article, How Do People Keep Bidding Prices Higher? So he said property prices in Australia have increased by 67% over 10 years. So someone who bought a decade ago, said hypothetically, might have seen their equity go from a couple of 100,000 to, let's say, 800,000. And therefore, people in the market can effectively upgrade to a much more expensive property. And if you look at the loan to value ratio across the whole housing market, it's about 22%. So yes, we've got sort of relatively high household debt in Australia, but not as compared to the value of the housing market. And of course, there is that kind of wealth effect from that. So, I mean, his view as such, there'll be no meaningful reduction in property prices. Household wealth in Australia is above $17 trillion. So that's more or less tripled since the lows of 2009. And I saw the UBS Global Wealth Report was just popped up in my feed this week. There's an extra 1.9 million US dollar millionaires in Australia last year. Second highest wealth in the world after Luxembourg, which is probably probably not a very good comparable country, but basically as rich as anywhere in the planet if you're looking at the median wealth per adult. And Australia's been right up there since the mining boom, really. So, yeah, I guess just a quote from Cam's article, some people seem perplexed as to how people can keep paying more for homes, but with how much equity most borrowers have, it's not difficult to push prices higher. And yeah, I guess as interest rates come down, there's the expectation that it'll be more of the same over the next few years.
I think this is just what shows the property market's got such a big lifestyle living element to it as well. And even if it doesn't make financial sense, it makes sense for security and stability and lifestyle reasons. And, I think that's just, unfortunately, also our rental market. If we had a great rental market, I think that's one of the things that causes FOMO. It's, vacancy rates, rents going up. That forces you to want to buy because you want that stability and security. I think, the mental accounting as well. Like if you take $1 million profit out of a property, that's great. But what do most people do? They don't go and downsize and buy a cheaper property and put it into shares or put it into super or start a business. We've sort of stifled innovation and entrepreneurship in Australia because people go, well, I need to put that back into a house, and I'm going to take a bigger mortgage on because I actually want to live in a different area, or I need a bigger house for my family. And there's just so much pent up demand in property markets that people often just need a bigger place. So they just keep funneling their profits back in. I mean, even when you go to the other end, when people do well, whether they win lotto or whether they do, sell a business or make a big bonus, often a lot of that money flows back into residential property. You see the attack on super in recent years, and even right now, that also encourages people to go, well, actually, I'll put this into property. And so I think there's just this real mental accounting thing that, even when people do well in property, that just the money just stays there. And then often, and even if you think about intergenerational wealth, people are living longer and longer. They don't want to go into aged care homes. They can't downsize because there's not apartments that suit them. They live in their house for longer and longer. Even the government encourages them to stay living in their house because, it's cheaper to do that than, say, go to aged care. And they're living longer and longer. They finally die and they pass it down to their 1-2 kids, and then they pass to their grandkids, and that money flows back into property. It either pays off mortgages or it basically goes to grandkids who then re-leverage it into properties. And so, yeah, you even at the end of the line, the money goes back into property. Is that sort of your view as well, Pete, on why a lot of it flows back into residential property?
I think so. If you track the total return from housing versus the total return from the Aussie stock market, of course, it depends on where you start the numbers, and the data gets a bit sketchy the further back you go, but it's more or less the same. If you go back over the past century, low double digits. And yes, there's periods where stock markets have done better and then they come back, and vice versa. But if you look at it, the returns are incredibly similar, which kind of broadly makes sense in terms of what you're saying, because if people have a successful business exit or successful sports stars, a lot of that wealth just gets capitalized back into property. And there'll be periods where the stock market looks more attractive, but then the returns catch up. But it's remarkably similar returns, really, if you go back over 100 years. In Cam's article, he pointed out that between December 99 and December 2024, so a quarter of a century, the total value of dwellings has risen by just over 400%, but the value of residential land has increased 726%. Now, of course, thinking back to the time of the Sydney Olympics, just spitballing, I think the population of Australia was about 19 million or thereabouts. That was living in Sydney at the time, much smaller city back then. Well, now the population's 27? So of course you would expect the value of land and buildings to be higher because there's just so many more people. But restricting the availability of land has been that's been a key driver of the increase, and you can see why people leverage into that. 700% increase in land values, even if the specific asset you buy has done just a portion of that. It's a pretty tasty return when it's sort of leveraged over long periods of time and compounding away. So, I think, pretty much exactly what you said, really. Of course, the elephant in the room here, to coin your phrase, is that it's harder for the next generation, if prices are sort of elevating away from them, to make that first step onto the ladder, which, of course, is why governments are so focused on first homeowners grants, stamp duty exemptions, low deposit schemes, all this kind of stuff, because they want the next generation to participate as well.
Yeah, and I think that leads perfectly into our second story, Pete, which is around stamp duty. Should we go there?
Yeah, so there's a couple of articles this week. So the Australian newspaper led with stamp duty burden hits new records. So I think the stamp duty, the median stamp duty is now 31,000 for Aussies, and for non-residents, if a non-resident wants to buy in New South Wales, the stamp duty might be like 160,000 because of the stamp duty surcharge. They pointed out that stamp duty take in this cycle in Queensland has tripled, partly because there's just more transactions, but also because people are paying so much more now for stamp duty. The stamp duty thresholds and brackets were really designed with much lower property prices in mind, and it's just same problem in the United Kingdom. If you're paying, say, 3% stamp duty, a lot of people will just not bother moving. Why would you pay all of that tax to downsize when you could just stay put. So it does sort of diminish activity in the market, and it has impacts on the labour force mobility and so on. Yeah, I think a key point in the article, and the HIA, the Housing Industry Association, raised the same point, is that we've got this enormous tax on foreign buyers, and the only time we've delivered high numbers of housing, the high number of dwelling units, has been when foreign buyers have been massively active in the market, and we've basically taxed them out. So it depends. It depends on your take on it. Some people would rather see fewer foreign buyers, but if that's a key driver of the new dwelling supply, probably shooting ourselves in the foot there as well. But I imagine you guys get this question all the time about, how much, how small a deposit can I put down, because I need to save 30k, 40k, or whatever it is for the stamp duty, and it's a big part of the hurdle, I suppose, for people getting onto the ladder, or for people wanting to sort of upgrade or downsize, because it's just a whole load of extra costs that are just going straight to the government's coffers.
You got to think about this from the development point of view. Here is we need more dwellings for the rental crisis that we've got. That's why our rents are going up. That's why vacancies are so low. We haven't got an oversupply of apartments, etc. Developers can't sell them because they need to build a high quality product because they're driven by owner occupiers, and that costs more money. It's more expensive than what it costs to build and what borrowers can borrow. So there's just hence why we've got a freezing up of the construction issue on top of all those other issues we spoke about. So you got to think, in that scenario, is it wise to go to investors who maybe don't care so much about the cost, and who have access to cash to basically fund our development industry? And so why would you be taxing foreign investors right now with a big stamp duty tax if they're buying new property? Shouldn't you be just encouraging foreign investors to basically support our construction, to make more dwellings? That'll help our rental supply. That's the way I look at this one for this. Right now in the cycle, it's not foreign investors out competing first home buyers or other investors. They're just not getting built. And so I'd rather them getting built, to be honest, and creating dwellings for us as a country, because I think we need it. And if they don't have to, I'd actually be probably having no stamp duty for them, to be honest. I think also, I do think that, there's a lot of push all the state governments from stamp duty to land tax. I think people think it doesn't make sense it stops people moving to houses that better suit their needs, at all stages, because it's just such a big burden. It's just money that just goes up in the air as soon as you transact. It's just lost. It's not reinvested. It's just given straight to the government. And so people are very anti, wiping out on top of agent costs. You could be looking at maybe 8% of your transaction, or even more, in some sunk costs and styling, and they just go. And so people are very anti doing that on top of everything else. And so it makes sense to have no stamp duty, have a land tax. But unfortunately, when you implement a land tax, it's not so simple. You'd want to have to implement it across the whole state on every dwelling, owner, occupier, and investors. And you'd have to have this big broad-based thing. And you have to argue, if you paid stamp duty in the last 5-10 years, should you be paying land tax? If you paid stamp duty 10-15 years ago, should you pay land tax? And so it's very hard to implement at a broad level. But I do see it maybe coming in for first home buyers, kind of what New South Wales government tried a couple of years ago with Dominic Perrottet. I could see that coming in with first home buyers, because a lot of first home buyers, they don't hold those properties for very long. And so you pay a lot of stamp duty, and then you sell it 5-6 years later. It's not your forever home. And so I feel like, giving them a bit of a kick, letting them go land tax, it would make a lot of sense. And I also think on the other end of the scale, downsizers just don't downsize because they go, well, I just don't want to, pay the stamp duty. I'd rather keep my property growing tax free. And so I see some downsizer exemption or possible as well, just to start to create a better structure to our housing supply.
I think the people's fear with land tax is that once governments get their teeth into it, then it could just keep increasing, and you could end up with, trying to think of a good example, a city like Houston or somewhere like that, where you've got very punitive rates of annual taxes, property taxes, and then people don't want to own a home anyway, so it becomes a bit circular. Home ownership rates in Australia have historically been quite high, but if it becomes a an annual burden, then why would you bother owning a house in the first place? So yeah, it's a bit chicken and egg, I suppose. Just to wrap up on that story, Tim Reardon, chief economist at HIA. Good guy, Tim. 3 parts gin, 2 parts economics, as he says. He's a gin distiller in his spare time. He said state governments have introduced punitive stamp duty and land tax surcharges, with rates now as high as 9% in New South Wales and 8% in Victoria. So we're completely shooting ourselves in the foot if we want new housing supply. I think it might have made sense at a certain point in time some years ago when there was sort of a lot of Chinese capital coming in, and there was a risk of sort of overbuild in some areas and stuff. Well, now we've got the opposite problem. Nothing's getting built. And as you said, if you don't get the pre-sales on projects, there isn't really speculative lending in Australia or speculative development. You need probably half the apartments in a project to sell, and without foreign buyers, it's pretty hard. So let's do our third and final story this week. This is from Domain. 1 in 6 have a deposit for the first home buyer scheme. So recall that from January 2026, there'll be a 5% deposit scheme available for first home buyers as to be implemented by the federal government. So Domain estimates that about 15% of 25 to, I think it was 25 to 40-year-olds in the article, I have to double check that, have saved at least $41,000, which would be enough to buy a median price property with a 5% deposit. I think, Chris, you would probably point out that some first home buyers will have some challenges around serviceability. And I suppose just to add to that, I mean, there's often this sense that a first home buyer should be able to buy a median priced house, but actually, when I think back to when I started my first property, you buy the cheaper end of the market because you're a new entrant. So just because because you might need 40 odd thousand for a medium price property, like, it doesn't necessarily follow that's what you need. It depends where you're buying and whether you're buying a unit or in a regional market or whatever it might be. So yeah, are you getting much inquiry from first home buyers, or are they by and large going to be waiting until 2026?
There's always a pent-up demand of first home buyers, right? Obviously they're renting, their lives are changing, they're getting into couples, they're breaking up, they're building their deposits, and they're getting, I guess, more older. And as they get older, they get more security. Well, they want more stability, right? And they want more security, and they're thinking about having kids, etc. And so I think there is just this, and we're pushing it out later and later and later. And I think the way to think about the property market sometimes in terms of demand, it's the owner-occupier rate. The lower that is, right? If 80% of people own homes, and there's only 20% of people that some of them actually will want to rent, and some of those would want to buy. So there's very little demand there, or future demand, if everyone owns a home. But if that owner-occupier rate's reducing every year, which it is, and it's also reducing particularly for sort of younger people, and it's nowhere near, it's 70% or 80%, then that's sort of pent-up demand, I say, in the property market. Not everyone wants to buy, right? There's a lot of benefits to renting, and particularly if you've recently moved here, or you're going to move overseas, etc., or you're going to move to a different state. But that's a really good litmus test to show that there's still a lot of demand for first-home buyers in the market. And I think the veil has been lifted a little bit. I mean, there's been this sort of rent vesta, I'll just rent wherever I want forever, and this sort of share economy, say 5-10 years ago, the Airbnbs and the Ubers, when that was all going nuts. I'm not even going to own gardening stuff because I'll just use the local shed. There was this mentality that was going on. I think the veil's been lifted on the challenges of doing that when there's an undersupply of rentals, and rental prices go up, and you get kicked out of your rentals, and you go put applications in on 20 properties and you can't even find something. I think that's what's happened over the last few years. And so I think a lot of first-home buyers absolutely are still there. I think this 5% deposit scheme, there hasn't been much noise on it really over the last months, I would say, across the media outlets, which is a bit surprising because really January is going to come around really fast, and you can still do it now prior to January within certain price caps. But even though people are going to struggle with serviceability, I think if you're a first-home buyer, you'd be like, well, if I wait for my serviceability to go up, I could pay higher prices. And so it just makes sense to get something now versus waiting another 6-12 months for when maybe more borrowing capacity comes or my income goes up, etc. And so I think as the months tick over, October, November time, I think you're going to see a real influx of first-time buyers, particularly when the media storm get behind it, which isn't the case right now. But the stats are all there, particularly if the government's come out. I know Victoria have talked about this with stamp duty concessions for first-time buyers. If the state governments come in as well and say, hey, we're going to reduce the stamp duty for first-time buyers on top of this policy, you can't. That's the best purchasing time for first-time buyers in terms of the smallest deposit I've seen, particularly at higher price points that first-time buyers have ever needed.
Yeah, so here's the stat from the article. 15% of 25 to 34-year-olds have got at least $41,000 in savings. So that would be enough to put down a 5% deposit on the median valued home in Australia of $825,000. 4% of those buyers have got enough cash to put down 20% deposit. I think here's the sort of hidden message in the article, because there often is that kind of thing. Westpac senior economist Matthew Hassan said 400,000 young Aussies qualify for the scheme, but tight serviceability tests are creating exclusions. And this is something we've talked about previously. The lending assessment buffer at the moment, there's a 3 percentage points assessment buffer. That's shutting out a lot of low-income earners out of the housing market completely. Now, the Council of Financial Regulators actually met over this past week, and their latest quarterly statement suggests no change to those settings. So I think it's good change in the future, but for the time being, it looks like it's going to be pretty tough for first-time buyers to get the serviceability, even if they do have the deposit. So that's something we can watch as the year goes on. Chris, let's try and wrap up with a few listener questions. Here's one from Ben. I know you don't have a crystal ball and you can't guarantee anything. I'm after an honest second opinion. Is thinking about holding a rental property. The real estate agent suggests you should just get it sold in August. He's not sure if it's the best time of year or whether he could be giving up on gains. Look, I don't have any details on where and what type of property it is, but just in terms of the time of year, do you have a sense of is it better to wait for the spring selling season, or do you just try and sell when there's less stock on the market at a sort of a quieter time? I suppose my gut feel is at the moment, if it's a property that's not causing you headaches, there's probably no big rush. Interest rates are coming down, rental market's tight, so you'll have no problem finding a tenant. So you might just want to wait for that FOMO to build and cash in later. But obviously, with a caveat, I don't really know because I don't know which city or property type we're talking about.
Yeah, I think absolutely. It's not 23, it's not 24, which is really tough. And a lot of investors bailed, which, the cash flow on their home loans was really high, 6.5% interest rates, plus the principal on top of that. People getting smashed, and they don't want to lose your home, right? We always said this in 22, 23. People do everything to keep their homes, and they'll ask parents, they'll ask family, they'll sell everything they've got, they'll, basically bring forward even annual leave. Like we saw absolutely everything that the clients would do to keep their home. Do they go to those same extent to keep an investment property? Absolutely not. You just bail. And so, look at the PIPA reports over 23 and 24, the amount of investors bailing, which kind of leads into our last point around the issues around the rental supply, is that if you didn't have to keep it and it meant keeping your home, you would sell. In saying that now, home loans are going down on people, only 0.5% right now, but it could be another 0.25 next month. So that sort of other side, right, is sort of closer. And homeowners are like, well, yeah, if I can really bridge myself to the other side of that gap, maybe to early next year, maybe, interest rates will be 5% on my home loan. Maybe I could pull some equity out, borrowing capacity is going up. Maybe I can find a way to get through. Maybe I don't have to sell that investment property. And so that's actually going to create less supply, I reckon, over the next 6 months. I do think there's some investors who still need to bail and absolutely will bail. But if you're in the situation, Ben, where you don't really need to sell it, you'd have to argue right now there's a tailwind behind property prices, not a headwind. Every single rate cut, more demand comes in, particularly if other investors don't want to sell. That's going to, causes prices to go up. But every market in the whole country has different demand and supply dynamics. And so it really depends where you've got your property, Ben. But at a broad level, it's not 23, 24. You're sort of getting to the tail end of this pain of interest rates. And you might say, well, and markets can run really fast. They might not have done much over the last few years, Ben, but if it's a good asset, you might want to hold on to it and try to, ride this wave of, lower rates and higher capacity.
That makes sense. So let's go through this second question from Danny. What are your thoughts on the Canberra property market? I'm heavily invested in the Canberra property and not sure why with low unemployment and high incomes, the territory is lagging behind, for example, Melbourne. Is it due to working from home trends? I think, Canberra is kind of probably a somewhat unique property market in Australia. As you said, it's always had the highest median household incomes and household disposable incomes by far across the country. And that includes the resources states like the Northern Territory or Western Australia, largely because it's mostly government roles, highly educated, a lot of sort of civil servant type roles or public sector jobs. So that is definitely one of the things that supports values. I think, yes, and it's also always had low unemployment. As we know, over the past couple of years, huge amounts of the jobs growth in Australia has been from non-market jobs. Labor government, traditionally, more government spending. So all of that stuff is tailwind. I think there's a couple of things that have counted against Canberra just of late. One is that it did have a tremendous run previously. It kind of fared pretty well in terms of dealing with the pandemic. And sort of median prices. I think the median dwelling price is over 800 now. So I guess for a house, it will be sort of around the $1 million plus point. So it's had a pretty damn good run really over the past 25 years. I think the other thing as well is that for investors, property rates have gone up about 80% or something over the past decade, more than in any other sort of jurisdiction around the country. So there's the tax issue. And as you mentioned, Chris, actually, Canberra was the pioneer into phasing out stamp duty in favour of the annual land tax. So maybe some uncertainty around that. But for whatever reason, there never seems to be enough land released in Canberra. And yes, it feels a bit artificial in some ways because, there's all that sort of land around the city, but it never seems to get built on. So any sort of additional thoughts there?
I think your point around it did have a pretty good run, right? And when the rest of the country did, and if you look at the sort of 2020 to 2022 period, it went up significantly. I mean, and maybe it just hasn't got that sort of FOMO in the market and the confidence just needs to rebuild there. And I think, but as, maybe just affordability stretched. I mean, higher incomes up there, but maybe just hasn't had that FOMO to kick in and it's just sort of holding prices a little bit. But it did have a huge adjustment over that 2019 to 22 period. I'm just looking at the growth in the market over that period. It was, and markets often do that, right? They go on runs and then they go through periods of consolidation. And so I don't think you'd be worried about the long-term fundamentals behind the Canberra market. And maybe just not, I don't know, in the government sector, I haven't got the stats in front of me, maybe just the optimism around, wage growth, job opportunities in Canberra. Maybe it was all when they were splashing the cash back in that period. Maybe there's a bit of a sense that things are going to be a bit tighter. Maybe there's redundancies and cutbacks in their government spending. I don't know. I'm just sort of just putting it out there. And so maybe some of those that confidence isn't there with leveraging up, and it's also just really hard to leverage up right now. So people maybe just haven't got the borrowing capacity to make those next steps due to the last run in prices. The apartment market down there, I was down there maybe a couple of years ago at a conference, and I was sort of shocked at how much apartments were happening down there. And I think they've had a real tough time. I think they're overbuilt. And off the back of that last boom, often when house prices run, apartment building happens after. And I think the Canberra market apartments have struggled. But the housing down there, I think it's just got all the right fundamentals, particularly if you're in the sort of more established suburbs closer to the town centre.
Cool. Let's do one more question, then we can wrap up for the week. This question from Coffee. Hey lads, will Gen X and millennials step up and take over the property market investment side of things like the boomers did? Or will they be more inclined to go for shares, superannuation or Bitcoin and only dabble in property over the next decade? Somewhat reminded, I remember reading one of the lads mags years ago about how there would always be these articles saying, music is no longer the big thing. It's going to be, yo-yos or Tamagotchis or Nintendos or fidget spinners or whatever it is. But then like every time it was just music was the thing that people kept coming back to. It feels a bit the same with the property market. I remember, when I was starting out a few years ago now, before the grey hairs, and people were saying, well, this generation's not going to do property because it's too expensive, nobody can afford to buy. And, by and large, I would say investor numbers have been quite similar through the generations. So I don't necessarily think that will change. I think it's there may be more choices for investors in the future. I think the big sort of X factor is what happens with that intergenerational wealth, because all of that boomer wealth has got to go somewhere. So when that gets passed down, will people still be inclined to put it back into real estate? I think yes, for the buying places to live. I think for a property investment, it probably depends on whether we see a shift towards more institutional housing. Certainly in Europe and the US, we've seen that people frankly can't be asked with a lot of the hassle of owning property, and a lot of it falls to institutions or corporate landlords now. So I think we will sort of shift in that direction. But yeah, I just think in terms of the demand for housing, I don't think that's going away. But maybe just on the investor side, I think it might shift more from sort of private landlords into the corporate world. What do you reckon, Chris?
Look, I think I do think they want to own homes. I think all the stats and the research out there, kind of one of my last points around the share economy versus, maybe back then they were like, yeah, I can just rent. I love the flexibility. I never want to own a home. And as millennials and Gen X get older and they couple up and they potentially have kids, then their desire to own goes through the roof. And I think even Gen Z, the next generation, have a desire to own a home just as great, if not greater, than the previous generations. Now, from an investing point of view, I also think that a lot of Gen X, Gen Z, Gen Y, Gen Z are also getting used to investing a lot easier than it was in previous generations, right? Apps like Raise or Stake or and even just having an interest in it, this whole podcast and Australian Finance podcast, etc. There's a lot more appetite for, doing something for your future, and people owning their future a little bit more. So I do think investing is going to be higher, rather than just buy a house and hold it. Do they buy investment properties versus share or super? Super's a hard one. I think really hard to motivate the next generations to put more money away for their future, particularly now they're attacking it a little bit. So I think there's always going to be caps on that. And there's always caps anyway on what you can do based on your income. Do you go shares versus property or Bitcoin versus property? I just think because of leverage, and the ability to leverage your money much further, you don't need ridiculous returns in property to sort of way outperform. And there's a lot of fear around, people maybe invest in Bitcoin when they're riding their wave up or roller coaster up. And when it goes through one of its correction cycles, you've got to be, have pretty strong guts to ride down the wave down and then hold on through a 40, 50, correction in prices, and then wait for the next leg up in prices, let's call it. And so a lot of people just can't stomach that volatility. It's just the reality. If you've got, $100,000 in Bitcoin and it drops to 50, and then you've got to be really confident to hold it back to 100 and then back to 150 if you think it's going to get back there. So I think that's my experience. I think with the crypto world is that very few can hold it through the cycles just because of the volatility. But shares, I think just dollar for dollar, buying $50,000 of shares or a $500,000 investment property, you don't need ridiculous returns just to wipe out the potential after-tax ROI. So that would be my take with that one.
Keep sending in your questions. There's a link in the notes. Also, come and join us at the Rask Community Forum. That's community.rask.com.au. That's not just property there. There's sections for business, shares, you name it. Come and join the chat over there. Pretty useful resource. So this weekend, what am I doing? My daughter's doing a ballet show Saturday and Sunday, actually. So I've been roped into being a taxi and in the audience and everything else. So pretty quiet one for me. What about you, Chris?
I think it's a very quiet one as well. I think a couple of birthday parties. No football this weekend. But yeah, very quiet, mate. It's I'm very boring at the moment, which is I'm not unhappy about. I actually quite like these
No
periods
news is
in
good
life.
news. Yeah.
Yeah, that's right. Cool. Awesome. Thanks for
Cool.
listening, everybody. Happy Sunday, and we'll talk to you all soon.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.